to the Rapid Roundup session on accounting for managers. So, in this session, we will be exploring the fundamental principles and the practical applications of accounting in a managerial context in a rapid roundup way, in a very condensed manner, maybe within around 1 hour or so. We will try to cover everything. So, if you are new to this channel, I am Anu, your guide and facilitator for this particular course. I run a small but growing YouTube channel that is named Anu's Classroom. It is aimed at helping IGNOU students like yourself overcome the limitations of distance learning by providing quality content. My goal here will be is to assist you not just in passing your exams with good grades, but also in helping you understand the concepts thoroughly so that you become better managers of tomorrow. In today's dynamic and business environment, you all know that managers are being tasked with making informed decisions that could drive the organization towards success, or if they miss their judgments, that it could even plummet the organization into failure. So, in this crucial juncture, accounting serves as a language of business. It is accounting that provides managers with all the essential tools and insights that are required to understand, analyze, and communicate financial information effectively. So, unless you are taking MBA in finance or banking and finance, if you are taking any marketing or operations related or HR related MBA, then you might not be required to prepare any accounting statements or anything like that, but you have to know how to read it, how to analyze those statements, how to understand what is written in that statement. That you have to know, so that you will not be fooled by anybody else, plus you will be able to look at it and take appropriate action so that your unit is driven towards success. And if you are anybody who is thinking about starting your business, or you have your own business and you want to increase your knowledge on management, then definitely I don't have to tell you, you should know accounting. Especially you should know how to read your books of accounts. Maybe an auditor will do all these things for you, but you need to be aware of, so that you can take right decisions for your firm. So throughout this course, we will delve into all the key accounting concepts and techniques that we have to know, equipping us with the knowledge and skills that are required to navigate the financial challenges and opportunities in your particular managerial role. So, from budgeting and financial analysis to performance evaluation and decision making, we will be gaining a comprehensive understanding of how the accounting principles inform the strategic and operational decisions. So, let us embark on this journey together, fueled by curiosity, determination, and a passion for learning above everything else. I'm very excited to accompany you on this transformative educational experience, and I'm confident that together we will surely emerge as savvy decision makers, ready to conquer the complexities of the business world. Let me provide you with a preview of what is awaiting us in the next couple of minutes, like in this hour. So, our roadmap for this particular course is divided into 5 blocks, and it has a total of 16 units. So, 16 units are divided into 5 blocks. Each block builds, or each unit you can say, builds upon the last one to deepen our understanding and equip us with valuable knowledge in terms of accounting. In the first block, we will be laying the groundwork. We will be exploring the basics of accounting, including bookkeeping, financial statements, and cash flow statements. In the second block, our focus is, we will shift our focus to cost accounting. So here we will look at concepts like absorption costing, marginal costing, activity-based costing, things like that. And continuing into the third block, we will explore the advanced topics in cost accounting, particularly like cost volume profit analysis, budgeting, variance analysis. And in the fourth block, we will try to broaden our perspective as we look at the financial statement analysis, covering techniques like ratio analysis, comparative analysis, and trend analysis. And finally, in the fifth and final block, we will explore the emerging issues in accounting, including human resource accounting and forensic accounting. I am very excited to join you on this journey, and let us see how we can do our best in understanding accounting. If you are not from an accounts background, if you are from commerce background or arts background and you know nothing about this also, don't worry. I've tried my best. I'll try my best to make sure that you understand it. And in case you need any more info, then we have a dedicated playlist for MMPC 4 where we are covering every unit in detail. So that has been made in such a way that it is friendly to people who are not from the commerce background, who have no idea of accounting before their MBA. I've structured it that way, so maybe you can take a look at it also after we are done with the rapid roundup. So I'm sure that will also help you a lot. But before we start our discussions today, I kindly ask you to take a moment to ensure that you have subscribed to Anu's Classroom and enabled notifications. If I am correct, you guys are in your first semester. We have 3 more semesters ahead of us. And I provide a lot of resources. I am still providing a lot of resources. I'm making videos so that your learning journey becomes easy. And the reason why I ask you to subscribe and enable the notifications is so that you can ensure that you never miss an update from my site, and you can fully utilize all the resources that I provide to support your journey towards earning the postgraduate degree from IGNOU with not just good grades. That is the key focus for me over here. It is not just that I want you to get good grades, but I want you to come out with understanding. Anybody can mug up things from the textbook and write down and get passing marks. That is not a very big thing to do, especially since we have this much of experience with us doing jobs and studying and all those things. So that is not a very big challenge. Anybody can do that. If I tell you if such a question comes, then you have to mug up these things and go and write, you can do it. But that is not the important part. When you have to work as a manager, when you do your job, the knowledge that you have from MBA, that matters, and I want you guys to have it. So feel free to leave your comments, questions, or any kind of suggestions that you may have below in the comment section. I'm here to help you out, so don't hesitate to ask anything. Just remember to keep them, whatever comments you have, please keep them professional, like you would in your future managerial role. That is all the ask is. But otherwise, you're free to leave your comments or questions or suggestions, and I'll try my best to resolve them. So let's dive into the world of accounting. Have you ever wondered how businesses actually keep track of all their money matters? That is where the accounting comes in. So accounting is like a glue, a financial glue which holds everything together, helping businesses make sense of their transactions as well as make smart decisions. Accounting is the meticulous process of monitoring a company's financial ins as well as out. How is money coming in, how is finance coming in, and how is finance getting utilized or going out. Both of these things are involved or are present in accounting. So it involves recording every financial transaction there is, categorizing those transactions and condensing this data into a comprehensive financial statement. Like it could be a balance sheets or income statements or cash flow statements. All of these things come into picture. So why is accounting such a very important aspect, especially for us MBA students, right? As I said, imagine yourself as the head of any company. So you will definitely only have one aim, that is to steer that company, to steer your company towards prosperity, towards success. So an understanding of accounting will help you by giving you insights into your company's fiscal well-being, financial well-being, and it facilitates performance analysis and guides investment decisions. Yet accounting is not merely just about numbers. You should not think like that. It is also what you can say a language of business. So proficiency in accounting empowers us MBA students to communicate effectively with our peers in the corporate realm, whether it might be about whether it might be to investors, or whether you are negotiating with your creditors or navigating any kind of regulatory framework. Accounting is going to help you. So in essence, accounting, you can say, is the backbone of any kind of business operation, providing MBA students with insights into financial data, informed decision-making capabilities, and a fluency in the corporate lexicon. Now let us dive into the intricacies of accounting cycle, which is similar to, you can say, a very, very meticulously crafted choreography, where each step seamlessly transitions into the next. So let us begin with analyzing transactions, scrutinizing financial data to discern the impact that they have. Okay. So then after that we will transition to the recording phase. So first, the accounting process, it all starts with analyzing the transactions, right? And then we record the transactions. We record each and every financial transaction that is being done within our accounting system. And once it is recorded, transactions will be posted to the general ledger. This will ensure there is systematic organization to your transactions, and subsequently we will craft an unadjusted trial balance, which is again essential for ensuring that we have journalized and ledgerized all the financial transactions properly. But this journey does not end here. Once we prepare the trial balance, we might see that some things don't add up. So what we'll have to do is we'll have to make adjustments so as to portray the true financial picture accurately. And following these adjustments, we will prepare an adjusted trial balance before moving on to the main event. And what is that main event? Crafting the financial statements like balance sheet or income statement or cash flow statements, such things. So financial statements are, you can say, very important because they narrate the company's financial journey through the balance sheets, income statements, and more. And as the curtain falls, when the year comes to an end, we will conclude all the finances of that particular term with closing the books. That is, we will settle the temporary accounts and we will transfer their balances to the main accounts. This settlement is what this settlement happens with the preparation of a post-closing trial balance, ensuring all is in order before we wind up our financial year. Now let us explore the symbiotic relationship between bookkeeping and accounting. Bookkeeping and accounting are often misconstructed. They are used interchangeably, but you must understand that they play very distinct roles. Yet they are complementary to each other also. How so? Bookkeeping meticulously records financial transactions, forming the bedrock upon which accounting stands, whereas accounting transforms this raw data that is given by bookkeeping into meaningful insights, guiding businesses with strategic financial counsel. Together, bookkeeping and accounting, both of them together, forms a very important team. You can say bookkeeping plus accounting. And this together is what steers businesses into financial success amidst the very competitive corporate landscape. Now, let us dive into the diverse branches of accounting. So, financial accounting gives us the statements for investors, creditors, and regulators so as to assess the company's financial health. So, that is one branch. Then we have managerial accounting, which gives us insights to make informed decisions. We have another branch called as tax accounting. It offers salvation during the tax season. We have auditing, which ensures that the financial statements are accurate. We have forensic accounting, we have cost accounting, and there are many other branches of accounting as well. So why is accounting information pivotal? Why is it so important? It is important because it guides investors, creditors, regulators, basically all the stakeholders of a business, as well as management, in making informed decisions, ensuring there is a fair play and propelling business engines towards success. So investors, they rely on this accounting information to assess the financial health of our company. Whereas if you take the case of creditors, they use this particular accounting information, the same accounting information, to gauge, to see how creditworthy our organization is before passing us loans or giving us any kind of credit. Because they have to know, right, whether we will be able to pay it back or not. Whereas regulators, they use this accounting information to ensure that our company is in compliance with all the standards and regulations. The same accounting information, when it comes to the management will use it to navigate the business landscape, to take appropriate decisions based on our accounts. So in summary, you can say accounting is like your Swiss Army knife. Have you seen a Swiss Army knife? All different tools, all packed into a very small pocket-sized tool, right? So accounting is like that. It is like a Swiss Army knife of your business. It offers a lot of functions and endless possibilities. Whether an adept accountant or a curious MBA student, whoever it might be, understanding its intricacies is indispensable for navigating this world of finance and of business. I hope you are clear about that. I hope you now have an idea or a clear picture of why you should be learning accounting and the importance of it. So now that you know, I hope now that you have understood that there is no escape for us. If you are a manager, or if you are a business owner, or if you are hoping to be a business owner one day, you cannot escape from finances. You cannot escape from accounting. So since it is inescapable, what do we best do? Let us give it our 100% effort to understand all there is to understand about accounting. Let's make that a pledge for the next hour. For this duration of the session, at least make it a point that you pay 100% attention so that you get the maximum out of it. So now that we have got a taste of accounting basis, let's take a deeper dive into the intricate world of accounting process. Okay, so get ready, because now we are going to plunge into this vast ocean of accounting. We are starting our descent. So the accounting process, it involves 6 sequential steps. As we said in last time also, in the first unit also, there are 6 steps here. That is identifying transactions. First step, identify your transactions. Which all transactions are taken up? Only those transactions which have a monetary value assigned to it. Okay, so if there is money involved in any kind of transaction, then and that too not just any money that is in relation to our business. So if the business is gaining money or if the business is losing money from its pocket, either way we have to note it down. So that is identifying the transactions. Once we identify the transactions, we have to record them in a journal. We have to classify it, we have to summarize it, then we have to analyze it and then interpret it. And once all these things are done, finally we have to report the financial information. So this process repeats in each accounting period. Usually accounting period is a one year. It ends March 31st. I hope you are all aware of that, right? Accounting period ends at March 31st. But we can have intermediate also, like every quarter or every half yearly also we can close our accounts. It depends. But generally, for all regulatory purposes, you must close them on March 31st. So it repeats in each accounting period, ensuring that there is accurate preparation of financial statements like the profit and loss account and the balance sheet. So let us begin with the identification of transactions. So we will have to first start by determining which accounts are affected by any particular business transaction. This will involve identifying the specific accounts that are impacted by the transaction. Like for example, let us take a very simple example, that you as in the business has bought a new equipment, like a new machinery. So what are the two accounts that have been affected? Say you bought that machinery with the cash that is there in your hand. So what would be the two things? One would be your cash in hand, which got reduced because you gave money out. The second impacted one would be your machinery account. Yes. Why? How is that impacted? It got a machinery in with that money which went out of the cash. So these are the two accounts that got affected. Now that we know that the specific accounts that got impacted by any particular transaction, we have to ascertain the nature of these accounts. So we will classify them into categories like personal account or real account or nominal accounts. Personal accounts relate to individuals or organizations, whereas real accounts involve assets or properties, and nominal accounts pertain to income, expense, loss or gain. So in this particular case of buying a machinery with the cash that you have, hits a real account. Why? Because you are getting a real asset or a property. And nominal account. Why? Because it is an expense. Okay. So understanding the golden rule of accounting that is applicable to each type of this account, and we will apply it. So for personal accounts, we will debit the receiver and credit the giver. Whereas for real accounts, we will debit what comes in and credit what goes out. And for nominal accounts, we will debit the expenses and losses and credit the incomes and the gains. Okay. So now that we have identified and understood our transactions, we will record them. Where? Very first, we will record them in the journal. We follow the dual aspect concept of accounting, where each transaction affects at least two accounts in equal but opposite ways. So suppose say a transaction of 50,000 is there, it debits 50,000 from one account and it will credit the same 50,000 to some other account so that it is balanced. So for instance, let's say when a company borrows money from a bank, its cash asset will be increased. So it will be debited. Whereas liability to the bank also increases. So that will be credited. This concept is represented by the fundamental accounting equation, that is assets are equal to liabilities plus owner's equity. This forms the basis of our double entry accounting and it ensures that there is accurate financial statements. Now let us look at the process of journalizing. To journalize a transaction, we will start by noting the date. Then we will debit the relevant account on the left side with a DR and the amount, followed by crediting the corresponding account to the right with the to and the amount. And we will also add a brief explanation in brackets and draw a line to separate the entities. With our transactions neatly recorded in the journal, we can now transfer them into the ledger. The ledger, again, it is another book of account which serves as the primary repository for all kinds of transactions, organizing them by account for easy reference and analysis. So each ledger account will be divided into debit and credit sides to accurately categorize transactions. So transactions from our journal entries will be posted to the corresponding ledger accounts based on whether they were debited or credited. Balancing the ledger accounts ensures that the total debits and credits for each account are equal, maintaining accuracy within the ledger. When recording business transactions, several key considerations become vital. Like transactions must be properly authorized and they must be supported by evidence. That is, they need to have some bills or receipts to ensure that there is transparency and accountability. Each transaction should be accurately recorded with all the necessary details, facilitating clear audit trails and analysis. Correctly classifying the transactions and recording them in the appropriate accounts is again essential for accurate financial reporting. Following accounting principles like the Golden Rule will maintain the integrity and balance of financial records. Recording transactions promptly and maintaining a current book of accounts will enable businesses to make informed decisions and reliable financial reporting. So now that our ledger is balanced and our transactions are organized, we can now analyze them to prepare the balance sheet. This is the ultimate snapshot of our company's financial health. Preparing this balance sheet involves gathering the financial data from the ledger and organizing it into two sections: assets in one side, liabilities or owner's equity on the other side. So the asset section includes items like cash, accounts receivable, inventory and property, while liabilities and owner's equity section encompasses liabilities like accounts payable, loans, taxes owed and owner's equity. After listing the information, you can calculate the total value for assets and liabilities or owner's equity. This balance sheet adheres to the accounting equation where assets are always equal to liabilities plus the owner's equity. You have to be very careful. You have to memorize this accounting equation. Okay, assets equal to liabilities plus owner's equity. Asset equal to liabilities plus owner's equity. This is very important for you to keep in mind. Okay. So adherence to this particular equation, accounting equation, ensures that the total value of assets always matches with the combined value of liabilities and the owner's equity. If it doesn't match, either you have got some money which you don't have accounting for, black money, or you have lost some money for which you don't have any. Somebody might have stolen some money from you. So that is why you have to be this balance sheet. Balancing of the balance sheet becomes very, very, very essential. So financial statements including the balance sheet, then we have the statement of profit and loss, also called as the income statement, and cash flow statement. All these financial statements, these three pillars, financial statements, they offer essential insights into a business entity's financial health as well as position, aiding stakeholders as well as future managers like you in informed decision making. So income determination is also a vital thing for tax compliance as well as financial planning, providing clarity on the available resources and the potential growth areas. As we already covered balance sheets in the last unit, we will now talk about income statement. Okay, so an income statement or a profit and loss statement is a financial report summarizing a company's revenues and expenses over a specific period, like say a quarter or a year, revealing its profitability through net income or loss. So it encompasses revenue, cost of goods sold, gross profit, operating expenses, non-operating expenses, taxes and net income. All these things are included in your income statement. Revenue is the income from sales. Okay, so the income that you get from sale of your products or your services is your revenue. What is cost of goods sold? So cost of goods sold, that is this COGS that you can see on the screen, that is the cost of goods sold. It covers the direct production cost. All the direct costs that you can directly link to the production of those products or services is the cost of goods sold. Then gross profit. Gross profit is the revenue minus this cost of goods sold before operating expenses. Okay, that is gross profit. Without adding gross operating expenses, revenue minus COGS is the gross profit. Operating expenses are the regular business costs. Okay, whereas non-operating expenses are not the core operations related. Any expense that you had to incur which is not related to any of the core operations that you do will be your non-operating expenses. The net income is the final profit or loss after deducting all of these various expenses like cost of goods sold, operating expense, non-operating expense, all these things, you minus it from your revenue, you will get the net income. So the income statement is divided into two sections. The trading account is one section. The other is the profit and loss account. So the trading account shows the earnings from the core business operations, indicating gross profit or loss. In contrast, the profit and loss account summarizes all revenues and expenses, resulting in net profit or loss. So entries in this account relate to the current accounting period, emphasizing gross profit, that is revenue minus the cost of goods sold, and net profit, that is gross profit minus the operating expenses separately. To prepare a trading and profit and loss account, we start by calculating the gross profit or the gross loss by compiling all the incomes and expenses for a particular period. And then we will create the trading account. Here we will record the sales revenue and cost of goods sold to calculate the gross profit or loss. Transfer this figure to the profit and loss account, offsetting it against indirect expenses and non-profit or non-operating income. Next, compile the profit and loss account by summarizing the operating and non-operating revenues and expenses. And finally, we will determine the net profit or the net loss by subtracting this total expense from the total income. The trading and profit and loss account is like a final statement which reflects the summary of all the revenues and all the expenses for that particular period, and it influences the overall profit or the overall loss that has been incurred in that period. The income statement and position statement. Position statement is the balance sheet. These two are the key financial documents revealing the business's financial well-being. The income statement outlines the revenues and expenses over a set period, indicating profit or loss. Conversely, the position statement showcases the assets, liabilities, and owner's equity at any given moment. These statements are linked with the income statement's net profit or loss carried forward as retained earnings in the position statement, illustrating how profitability influences financial stability. The next financial statement we have to learn about is the cash flow statement. The cash flow statement is again another important financial statement which shows the inflow and outflow of cash in a business. It helps to show the liquidity of a business and its ability to generate cash. The cash flow statement is again important because it provides information about the cash that has been generated and used during a specific period of time. So it helps to identify all the sources of cash inflows as well as outflows, which can be used to make important financial decisions. This cash flow statement comprises of three main elements. We have the operating activities, investing activities, and financing activities. The operating activities involve day-to-day cash transactions like sales or expenses, whereas investing activities will cover the long-term asset investments. Financing activities will have the cash flows from loans or share issuance or dividends. And by showcasing the cash inflows and outflows on these three activities, this cash flow statement aids in gauging a business's liquidity. Okay? How liquid your organization is, your business is, as well as how what is the capacity of your business to generate cash. So cash generation capacity and liquidity can be understood from this cash flow statement. So crucially, it informs the strategic financial decisions, and it highlights the potential cash flow issues that we may be having, making it an essential tool for effective cash management. In order to prepare a cash flow statement, we will first define the period under consideration. Then we will identify all the cash inflows and outflows from operating activities like sales or expenses. Then we will recognize the cash flows from investing activities like you invested in some new piece of equipment or maybe a plot of land, some kind of an asset, and from financing activities such as loans or any kind of dividends. Then we will calculate the net cash flow for each activity and we will sum them up. We will sum up all these three to determine the total net cash flow. Finally, we will add the total net cash flow to the initial cash balance to find the closing cash balance. So I hope you got an idea of the three basic financial statements of business entity. Let's move on to the next topic. Cash flow statement in particular is a detailed topic here. If you have any doubts, as I said, you can always refer to the in detail playlist on MMPC 4, which is already available in the channel. You can go through that. There I have discussed everything in detail with as many examples as was possible for me. So please do check that out. Many people have found it useful. Maybe you will too. So since this is a rapid roundup session, I'm not going in detail more than this. So because then you will not be able to cover everything in this very short span of time. So in the previous section, we saw the benefits of preparing financial statements for a business entity. It is not only because of these benefits that companies undertake preparation of these financial statements, but they are also required to do so because of the legal mandates as well. Under the Companies Act of 2013, which you will learn in detail in the coming semesters as well. Under this Companies Act of 2013, companies are mandated to prepare their financial accounts, the final accounts, maintaining books at their registered office, reflecting a true and fair view of their financial state. Accounts have to adhere to accrual basis and also the double entry system. The section 129 of this act requires boards to present the financial statements including profit and loss, balance sheet, cash flow, statement of changes in equity and notes during the annual general meetings. However, cash flow is not an obligatory one for one person companies. So if it is just a one person doing the everything, it's a one person company, then it is not obligatory, but other than that it is mandatory. Final accounts must accurately portray the company's status at year end. Specific laws govern sectors like insurance and banking, while others follow Schedule 3 for balance sheet and profit and loss. Compliance with accounting standards as notified by the central government is mandatory. Now let us look closer at what the law says about this. The presentation and disclosure guidelines for a company's balance sheet are detailed in Part 1 of Schedule 3 of the Companies Act 2013. The balance sheet comprises of two sections. Part 1 is of the equity and liabilities. Part 2 is assets. Within equity and liability, shareholders' funds are delineated into share capital, reserves, surplus, and money received against share warrants. Liabilities encompass the non-current, current, and provisionary items, whereas assets are categorized into non-current, current, and investments with further breakdowns including fixed as well as intangible assets as well as current assets like inventories and cash equivalents. Every entry on the balance sheet have to be cross-referenced with notes to accounts for clarity. Figures have to be rounded off based on the company's turnover. Compliance with accounting standards under the Companies Act of 2013 is mandatory, with Schedule 3's disclosure requirements augmenting these standards rather than replacing them. The Schedule 3 of the Companies Act 2013 specifies the structure and the preparation of the profit and loss statement as follows. Accordingly, the profit and loss statement is divided into two parts, Part 1 and Part 2. Part 1 shows the revenue from operations, the cost of goods that are sold, and the gross profit, whereas Part 2 will show the other income, expenses, and the net profit or loss for that particular period. The preparation of the profit and loss statement involves the following steps. First, we have to record all the revenues that are earned during the period. Then we will record all the expenses that were incurred during the period, including cost of goods sold, salary, rent, utilities, or any kind of other expenses. Then we will calculate the gross profit by subtracting the cost of goods sold from the revenue from operations. We will be recording any other incomes that were earned during the period, like interest income or gains from the sale of assets or anything like that. And we will record any other expenses also that were incurred during this period, like maybe interest expense or losses from sale of assets, things like that. Then we will calculate the net profit or loss for the period by subtracting the total expenses from the total revenue. The profit and loss statement should be prepared in accordance with the accounting standards as prescribed under the Companies Act of 2013. It should also be cross-referenced to any related information in the notes to accounts. The figures that are appearing in the profit and loss statement may be rounded off depending upon the turnover of the company. So we saw that the cash flow statement is a vital financial report that outlines the company's cash movements over a defined period. Typically, it is over a year in accordance with the accounting standard. So it is structured into three sections. As we said, once again, let us rewind. Cash flow from operating activities, investing activities, and financial activities. Okay. So now that I hope that you are clear with how this cash flow statements are done. So let us move on to the next section. So we have been discussing about cash flow statements from the past few units, but owing to its importance, we will again look a little bit more in detail into this. The cash flow statement reveals the movement of cash and cash equivalents within a company over a specific period, usually within a year. So cash, what is cash? Cash encompasses both the physical currency as well as demand deposits in banks. Okay, whereas cash equivalents refer to the short term highly liquid investments that are easily convertible into cash amount with minimal risk of value changes. So common examples of cash equivalents would be commercial paper, treasury bills, or short term government bonds, etc., all with a maturity period of 3 months or even lesser. They are readily accessible to potential buyers. They ensure there is quick conversion to cash whenever it is needed. So it categorizes the cash flows from operating, investing, and financing activities. The operating activities represent the core revenue generating function of the company, like sales and services. Cash inflows from these operating activities could include revenue from sale, whereas cash outflows encompass payments to suppliers and employees. Investing activities could be acquisition or either disposal, either acquiring or even selling of long-term assets and investments. Cash inflows could include proceeds from asset sale, whereas cash outflows could be to cover the purchase of any kind of long-term assets or any form of investments. Once again, let us rewind. Financial activities. Financial activities affect a company's capital structure, including changes in equity and borrowing. So, cash inflows from financial activities could come from equity or debt issuance, whereas outflows could be through dividend payments or debt repayments, like you're repaying a loan or something. So, preparing a cash flow statements require essential documents like balance sheet as well as income statement, utilizing either the direct or the indirect method. So, we have two methods of preparing cash flows. We have the direct method or the indirect method. The direct method computes cash flows, inflows and outflows directly, whereas indirect method just adjusts the net income for non-cash items and changes in the working capital. The direct method of identifying cash from operating activities will involve presenting the cash receipts and payments directly on the cash flow statement. Revenue and expenses are summarized from the financial statements, and the accrual basis figures are converted to cash equivalents. In contrast, the indirect method just adjusts the net profit or loss for non-cash and non-operating items to derive the net cash flow from the operating activities. Both methods offer insights into cash flows, with the direct method providing a more clearer picture, but it requires more detailed data. Whereas the indirect method offers simplicity, but it relies heavily on adjustments to net income. The choice between whether your company has to go with the direct method or the indirect method will depend largely on the company's preference as well as the data that is available to us. To prepare a cash flow statement using direct method, you have to arrange and present cash receipts and cash payments in the statement, as I said. So, examples of cash receipts could be cash from customers or debtors, royalties, or any kind of fees or commissions, whereas cash payments could include amounts that were paid to suppliers and or for purchase. These transactions reflect the actual cash inflows and outflows during the particular period, providing insight into the company's liquidity and operational cash flow. Now, once you have identified these cash receipts and payments, now you can calculate the net cash flow from operating activities. This will give you an idea of the cash that was generated or used up in the company's day-to-day operations. Remember that the direct method only reports cash transactions, whereas the indirect method will adjust the net income for non-cash items to arrive at the net cash flow from operating activities. To prepare a cash flow statement, you will have to start with the net profit or loss from the income statement. In the indirect method, I am saying you have to start with the net profit or loss from the income statement. Then the non-cash and non-operating charges put in the profit and loss account are added back, whereas non-cash and non-operating incomes are deducted from it to calculate the operating profit. Adjustments are further needed in current assets and current liabilities also to arrive at the net cash flow from the operating activities. So in our session, we highlighted that the accountant's role, we highlighted in the very first session itself, we highlighted the important role that an accountant plays as an advisor to management, focusing on gathering, organizing, and interpreting accounting information for decision making. However, it is the manager, it is us who ultimately bears the responsibility for making informed decisions. So that is why I said we may not have to prepare any of these statements. An accountant would be there to do that, but we need to understand the language so that we can make sense out of what the accountant is trying to tell us through these, right? So why? Because we are the ultimate people to make decisions based on this. Can we make a decision that goes against the finances of our company? No. So understanding costs become crucial for effective decision making, including cost behavior and its impact on profitability. So let us explore costs more in detail now. So what exactly is cost? Cost in general means the amount of expenditure, it could be actual or notional, that is incurred on or attributable to something. For example, if you have purchased a book for rupees 150, then it can be said that the cost of the book to you is rupees 150. Similarly, if a furniture manufacturer is making a table by paying 500 rupees for timber, 200 rupees as the carpenter's wages, and 100 rupees as the rent for the tools, then it can be said that the table cost him rupees 800. So this is just a general idea. There is no exact definition for cost or its interpretation, because the interpretation of cost depends on various factors. There are three broad elements of cost. There is material, labor, and expenses. Material refers to the substance from which the product is made, the raw material, which can be in either the raw form or maybe if it might be even in the manufactured state. Labor refers to the cost of the work that is done by employees to produce the product or the service. Expenses refer to all the other costs that are incurred in the production process, like say factory overheads or administrative expenses or selling or distribution expenses and things like that. So additionally, cost can also be classified in different ways, like fixed, variable and semi-variable cost. Even controllable and uncontrollable cost is another classification. Differential, incremental or even decremental costs are there. Out of pocket cost is there, opportunity cost is there. Like that, there are a lot of various ways in which costs are classified, and each have their significance in the managerial decision making process also. Fixed costs like rent, insurance changes, management salaries, all these things, they remain constant regardless of whatever level of output you are churning out. Whereas variable costs like direct material cost or direct labor cost or direct expenses, they fluctuate with the level of output. Similarly, semi-variable costs like telephone, electricity bills, they have both a fixed component and variable component. Controllable costs are influenced by those that are responsible for a specific center, while uncontrollable costs cannot be altered by the individuals who are in control. Differential cost denote the disparity in total cost between two alternatives. Where, like for example, what is the cost of buying tea versus what is the cost of buying coffee? Both are beverages, both have their own favorites, right? So that difference is the differential cost. Incremental cost, on the other hand, represents the additional expense that we have to incur when we are producing one additional unit. Decremental cost refers to the reduction in the cost when the output is reduced. Like when we did not have to produce, or when we produced one item less than what we were producing, that is decremental cost. When we produced one item more than what we produce, it becomes incremental cost. Out of pocket costs are the actual expenses that are borne by the company, whereas opportunity cost represents the value of benefits that were foregone by choosing one alternative over another. Total cost refers to the comprehensive sum of all the expenses that were incurred by a business in producing goods or services. So it encompasses the prime cost, which includes direct material, labor or expenses, factory costs consisting of prime cost along with all the indirect material, labor and factory overheads. We have office costs, which extends to the office and the administrative overheads. So what are these overheads? Overheads are the indirect cost which is necessary for operations, encompassing both factory and office overheads. Together, these components, they constitute the total expenditure that is involved in the production as well as administrative activities, providing a very holistic view of the financial resources that were utilized by the business. So a cost sheet is like a statement. It presents the different components of cost for a company. It is used to determine the total cost of production and to calculate the cost per unit. The cost sheet may be prepared separately for each cost center, and it may have columns to show the total cost or the cost per unit together with the relevant figures of the previous period. Cost centers are the specific departments or units within a business where costs are directly attributed or monitored. These cost centers help track expenses related to specific activities like production, sales, or administration, facilitating budgeting and performance evaluation. So examples could be the production department or the sales teams or the administrative units. Cost accounting involves determining the cost of products or services based on historical data and understanding the various cost classifications like fixed, variable, or semi variable costs. And in a manufacturing concern, the costs are identified and classified into direct and indirect costs. And then it is allocated to products or services using methods like job costing or activity based costing, ABC. It is described in detail, ABC. It is a very important method as well. So these techniques, they aid in pricing, production and profitability decisions. So understanding cost helps managers, financial managers especially, to provide advice and support for informed decision making, considering factors like controllable and uncontrollable cost, differential costs and opportunity costs. So overall, cost accounting techniques are vital for the effective cost management and business decision making. So in short, costing techniques are essential for managers in their decision making. Why? Because costing techniques will help to determine, control, and reduce cost, while at the same time improving the understanding of costing concepts. So we discussed about classifying cost into fixed cost and variable cost. How do we find out what is fixed cost and what is variable cost of a product or a process that we are doing, right? Only if we know how to separate, so we will have the overall cost with us, that we will know. But if we don't know how to separate out the fixed component and the variable component from it, then we cannot classify the cost. So we have to learn how to do that. So in order to find out the fixed component or the variable component of the overall cost of a product or a process, we have two techniques. And both these techniques we will learn in this particular unit. So first technique is the absorption costing technique and the second technique is the marginal costing technique. So now let us look at these two costing methods or costing techniques. Absorption costing is also called as traditional costing or full cost method. So here both fixed, so in this method it assigns both the fixed and overhead or variable overhead cost to production. So it incorporates all the direct and indirect costs to the production cost. So this will include all the direct material cost, the direct labor cost, the variable overhead, fixed overhead, everything. Whereas in contrast, if you look at the marginal costing technique, then only factors this marginal costing, it only factors in the variable cost to the product costing. It will omit all the fixed overhead costs. It might be a little bit confusing, especially if you are seeing or if you are trying to learn MMPC for the first time using this video, it might feel a bit confusing. So within the confines of our time limit, let me try to explain to you. So marginal cost actually refers to the expense of producing one additional unit of a product. So say usually you are producing 100 units per day. If I have to produce one more unit, that is 101th unit, what would be the difference in the cost? Okay, so definitely from 100 units, when you make it 101 unit, cost will increase. Somewhere or the other, cost is going to increase. So that additional cost, that cost of producing this one additional unit of a product, that is what marginal costing refers to as production cost. So it encompasses the increase in the total cost as resulting from manufacturing one additional unit, one extra unit. So this cost will cover all the direct material, direct labor and other variable expenses. This marginal cost calculation will involve deducting the total cost of producing say n number of units, okay, 100 units. So you already know how much cost you are having because as you're producing 100 units. Now when you produce the 101th unit, you will have a new cost, right? Maybe increased, maybe decreased, we do not know, but we will have a newer cost. So whatever cost you are having with 100 units, with n units, you are reducing that, you are subtracting that from the cost of producing this 101th unit. So 101 units, that is marginal costing. So it is a managerial accounting technique which focuses solely on the variable cost when you're determining the cost of products. When you do this method, as you can see, the fixed cost, whether you're producing 100 units or 101 units, it will remain the same. What will change? The variable cost. So that is why we are saying in marginal costing, it focuses solely on the variable costs, because when you do the difference, what you're going to get is the variable cost. So in order to perform marginal costing, we have to segregate the fixed and the variable costs. So some costs are fixed. What do you mean by fixed costs? Like rent, right? They are fixed. You have to give them no matter whether you do any sale or not. If you have rented a shop floor, you have to pay the rent. And it doesn't matter whether you made one sale or 1,000 sales in that month, you have to pay the rent, the same amount of rent. So that is why costs like rent are called fixed costs. Some are variable, like daily labor charges. Certain labor charges become variable. But what about semi-variable costs, right? Segregating into fixed cost and variable cost is one thing. There are certain costs which are semi-variable, meaning they have both fixed as well as variable component. And when we analyze costs, it is important that we be able to segregate these semi-variable costs also into their corresponding fixed as well as variable components. Now, there are many methods to this also. How to separate the fixed and variable components of semi-variable cost. For that also there are many methods. We have methods like the high-low method, which divides the total semi-variable expense by output differences at 2 points. We have the degree of variability method, which estimates variability for each cost item. The levels of outputs to levels of expenses method. This is another method which compares the output and expense variances. Then we have the scatter graph method plot, which plots data on a graph to identify the trends. So we have many methods. So basically we have many methods to classify costs. That much I hope you understood. Now choosing a method which method out of all these various methods that we have, choosing one particular method always depends on the availability of data as well as the suitability of that data for that method. That is also very important. So the segregation is definitely a vital thing for this marginal costing, aiding it in determining the break-even points and informing decisions on pricing, production levels as well as production mix. If you do not know about the break-even points, don't worry, we will be learning it. While taking decisions related to pricing, product mix or sales volume, as managers we need to know the amount of profit that can be earned by a business after covering all the variable costs, correct? So this profit that we can earn after covering all the costs, this is contribution. Very important thing to know, contribution. So, okay, so contribution is also known as gross margin. It represents the difference between the selling price and the variable cost, that is the marginal cost. It encompasses both the fixed cost as well as the potential profit. There is a formula which we can use to calculate this contribution. What is this formula for calculating contribution? If you have learned already, can you try to recollect? If you have not, then don't worry, I will tell you. So what is the formula for contribution? The formula for contribution is, you can say contribution is equal to, as we said, selling price minus the variable cost. This is one formula. Or we can also tell contribution as the fixed cost plus the profit. This is also contribution. So depending upon the kind of requirement that we have, whether we have kind of data that we have, if we have the selling price and the variable cost, then we can find out contribution using selling price minus variable cost. But if it is profit that we want to find out and we have the contribution and the fixed cost, then we would use the second formula. So depending upon what we need to find out or what data we have two different ways of finding out the contribution, or we have two different formulas for contribution using two different variables. So this profit materializes only when contribution surpasses the fixed costs, correct? So only if we can, cover our cost, especially the fixed cost or all the kinds of cost, only if we can surpass our fixed cost, we can get profit, right? If we don't cover the fixed cost, then we will go into loss. Now, break-even analysis stems from this particular principle. The break-even point, it is a point, or it is that point, that amount of money which we will earn or which we will get as revenue, and at that point if we make that much amount of money, then our fixed costs will be covered. That is, we are neither at loss nor we have made a profit, but we have covered all the costs, so we are not at loss. So that's zero, that break-even point. Beyond it, it is profit. Below it, it is loss. So that point, that 0 point, that is the break-even point. It is where contribution equals the fixed cost, resulting in neither profit nor loss. Managers also have to determine the level of sales or production that is needed to cover all the costs and make a profit. So this also can be achieved by performing the break-even analysis, because break-even analysis determines the point where the total cost equals the total selling price, and it provides insights into the potential profits at different activity levels as well. So this point, which is called as the break-even point, it is very important in our lives as managers, because it helps in forecasting profits accurately. It helps in setting the flexible budgets, evaluating our performance, and guiding the price policy formulation, and also determining the overhead costs. So achieving this break-even point quickly is very crucial for management decision making. So as you can see, the primary difference between absorption costing and marginal costing lies in the treatment of fixed overhead costs. In absorption costing, both the fixed as well as variable overheads are allocated to production, whereas in marginal costing, only variable overheads are included, with fixed overheads covered by the total contribution. Another distinction is in the inventory valuation. Absorption costing values the work in process or work in progress as well as the finished goods at the total production cost. So whether the product is not finished producing also, absorption costing will consider that it is all the cost is included in the total production cost. Whereas if you take the marginal costing, it only considers the variable costing. So that is the main difference, as you can say. So consequently, what happens is that the closing stock values will now differ between the two methods. So in summary, we can say absorption costing has both the fixed and variable costs, okay, but variable cost only focuses on the, marginal costing only focuses on the variable cost, impacting the product cost as well as the company profitability. So in a nutshell, marginal costing can aid management in optimizing the production volume and determining the most profitable price volume relationship. Why? Because it focuses solely on the variable costs. So it can provide insights into the contribution margin as well as the break-even point. But it faces certain challenges, especially in the area of categorizing the cost as fixed or variable. And it may not be suitable for long-term decision making either because of its narrow focus. But again, despite all these limitations, marginal costing is definitely a valuable method for short-term decision making and optimizing all the profitability that we have. So I hope you got a generic idea of what this absorption costing and marginal costing is. So since this is a rapid roundup session and I'm winding up these two things over here and moving ahead, if you need more data, then definitely go check out the MMPC 4 dedicated playlist. So far we saw about the traditional costing methods. So the traditional costing method of cost accounting categorizes the cost into fixed and variable components, and it is primarily used for financial reporting as well as inventory valuation to know about how much we can produce or how much we should produce, things like that. However, as we said, it struggles a little bit with complex cost structures, especially when we are trying to expand our businesses. So we need to know about another method of costing called as ABC. What is ABC? Activity-based costing. So it is a cost tracking, you can say it's a cost tracking method which links the cost to activities. And after linking the cost to activity, then we will link it to products. So it all begins by identifying all the activities that are involved in production. First, we will identify all the activities that are involved in production, and after we have identified all the activities, now we will link cost to each of those activities. And so how we will link the cost to each of these activities is based on how much resources were consumed while performing those activities, as well as we will also look at the cost drivers. What were the drivers, what was the factors which drove the cost for these particular activities. So ABC allocates all these costs to products according to all the activities that are required for the particular product's manufacture, right? Maybe a little bit complex to you, maybe. So I will try to explain it as much as possible. So this is a very detailed cost tracing which provides insights into production costs and aiding in informed decision making regarding pricing, product profitability, and resource optimization. So how does ABC stand out from the traditional costing is through the identification of activities using the cost drivers for a more precise cost calculation. So using this approach, the cost allocation is more streamlined, providing and it proves effective in scenarios where multiple products are involved and there are significant overhead costs. So cost drivers that influence activity cost like direct labor hours or the number of units produced, these are central to ABC, that is activity based costing. And in this method, cost drivers are closely tied to resources and activity consumption. So examples, you can say the production orders that are received or the labor costs, materials used, machine hours, with variations based on organizational and activity specific factors. So the main objective here is to provide a more accurate and reliable way of determining costs. So you can consider it as a more accurate and reliable way of determining costs. Why should you consider it as more accurate and more reliable? Because the focus here is on the cause and the effect relationship. Okay, the cause and the effect relationship in costing, and it can therefore identify actions that are not adding any value to the product. And so managers can put more control over such activities and can control the fixed overhead costs that are created by those activities. So while traditional costing is definitely simpler and it is suited for the basic financial reporting, this activity based costing provides a more precise understanding of cost, and it therefore is valuable for complex decision making in the production and product strategy development. There are several advantages for this ABC, including elimination of cross subsidization issues, handling complex processes and product customizations, identifying the cost saving opportunities, facilitating decision making regarding pricing, ensuring accurate cost determination, providing avenues for process improvement and cost reduction. So all these things are advantages of ABC. But as with advantages, ABC also has its limitations, its drawbacks. Why? Because definitely, as you saw, first we have to find out the cost, find out activities that are performed in the organization. Then you have to assign the cost drivers to it, and after doing that, now we have to assign each of these activities to the products. So it is a very complex system. It is not at all simple. It requires a thorough understanding of the product as well as the process of creating that product. So implementing this ABC entails a significant investment of time as well as money, along with the need for trained professionals who are capable of doing this ABC costing. So moreover, without support from the top management, this process will definitely not be completed efficiently. So cost determination in this method can be very challenging because a single cost may actually support several activities. Like for example, if you are running a bakery, you purchase one oven and that is running 24/7. That one cost of running the oven would actually support all types of baking activities that you have, whether you're baking pizza or cakes or cookies or whatever. All that activities would be supported with this single cost, right? So now how will you determine the cost of using this particular machine for each cookie or each cake that you're baking or each pizza that you're baking? It's a bit difficult, right? So, and then there will also be times where the oven is not being used. Then where do you allocate that cost to? So there are complexities here. So activity based costing is definitely beneficial for organizations which have multiple products, and especially those organizations that are producing multiple products and also having significant overhead costs. Why? Because it helps in the accurate cost determination through identifying activities as well as their cost drivers. So again, this method, it aids decision making by pricing products and services appropriately and finding avenues for cost reduction as well as process improvement. Okay, so it has advantages, at the same time it has limitations. So you can say in summary, ABC offers very accurate cost determination definitely, but it may not be suitable for all organizations, especially because of the complexity that is involved in doing this ABC, right? And the resource requirements that it would need. It needs a substantial amount of time. It needs a considerable amount of effort. And it all comes with the cost of doing this costing, because we need trained people and we need to give them the time to do it. So they will not be able to do other tasks, right? So there are a lot of costs involved in performing ABC. So if it is not suitable for your organization, or if it is not going to give any much of a value addition to your organization because of the nature of products that you produce, or the nature of or the scale or the size of your organization, then it might not actually be suitable to your organization. So it depends on the organization, on its products, whether to use ABC or not. because it is complex and it has certain resource requirements. So it is very important that we carefully consider all the merits and demerits before implementing or even thinking of implementing ABC costing method. So organizations have to carefully evaluate its suitability based on their size, based on the resources that they have, the technology infrastructure they have, before we start out on implementing this costing method just by seeing its advantages. Now, managers have to take frequent decisions which involve consideration of the selling prices, like how much can we sell our product for, right? Or how much discount can we give a particular product for in particular seasons, right? So we have to consider the selling prices. We have to take decisions on the selling prices. We have to consider or make decisions on the variable costs, similarly fixed costs. So many of these decisions are part of the planning responsibilities of managers, and it has to be done based on predictions about the cost and revenues. So cost volume profit analysis, CVP, a very important concept for you to learn from your examination point of view as well. Cost volume profit analysis is a very crucial tool in managerial accounting, offering insights into the relationships between sales volume, cost and profit. So it enables managers to gauge how changes in volume affect profitability in the short term and helps them in identifying the break-even point as well as the margin of safety. So this cost volume profit analysis informs various managerial decisions, including pricing strategy, sales promotion, distribution channel selection, even outsourcing. And by leveraging the CVP analysis, managers can optimize the product's profitability, assess the impact of volume as well as cost fluctuations on our break-even point, and even make informed decisions so as to enhance the overall business profitability. So how do we perform, how do we conduct such a cost volume profit analysis? We have to first segregate all our cost into, so it is a cost to volume to profit analysis, right? So first step is we have to segregate our cost into fixed and variable components. Once we have that, now we can calculate our contribution margin. You remember how to calculate the contribution margin, the two formulas that we learned? Rewind it, okay? That's why I said contribution margin is again an important concept to know. It will help you not just in MMPC 4 but also in the upcoming semesters as well, okay? So this is a very, very crucial, what you can say, it is a very crucial course for your MBA. So please study it with utmost dedication, utmost attention as much as possible from your end, because it will help you out in the upcoming semesters as well as your future roles as well. Okay, so you can, so the first step in cost volume profit analysis was to segregate the cost into fixed and variable component. Second step is to calculate the contribution margin using the formulas that we had learned. So next is, now that we know how the cost is segregated, and now that we know the contribution margin, we can determine the break-even point. Okay. So once we have the break-even point, now we can analyze the profit-volume relationship. How? We can use the information from the break-even analysis to make decisions about the pricing strategies and sales promotions and the distribution channels. And therefore, we can make informed decisions with a clear understanding of the cost behavior. So now managers can optimize the product profitability, identify opportunities for cost reduction, and make strategic decisions to enhance the overall business profitability. This profit graph, there is a graph called as the profit graph. It is again an important concept in the CVP analysis. Why? Because the profit graph is prepared after analyzing the profit to volume relationship. This profit to volume relationship is the first step in understanding our CVP analysis. Once the profit to volume relationship is analyzed, the basic framework of our profit graph can be presented. This profit graph that we are talking about is actually a visual representation of the relationship between the sales volume, the cost, and the profit in the cost volume profit analysis. It helps managers in understanding how changes in the sales volume could impact the profit and aid in decision making regarding the pricing strategies, the sales promotion expenditures, and even the distribution channels. So this graph typically plots the unit contribution against the sales volume. So the sales will be on the x-axis, the profits will be on the y-axis. Analyzing this profit graph can allow managers to identify the break-even point, where total revenue equals the total cost, as well as the point of maximum profit and the margin of safety. So ultimately, the profit graph serves as a valuable tool for managers to make informed decisions and improve their profitability. So all in all, we can say that the CVP analysis, this cost volume profit analysis, serves as a tool, a fundamental planning tool, forming the basis for profit plans and influencing various managerial decisions. This vital analysis informs decisions related to distribution channels, outside contracting, sales promotion expenditures, and even pricing strategies. So, the profit graph that is derived from the CVP analysis provides the crucial insights that are required to enable managers so as to make informed decisions regarding the mentioned aspects. So, overall, CVP analysis is a valuable tool. That much I hope you have understood, right? And it is how we do the CVP analysis. What are the steps? We have to segregate the cost, we have to calculate the contribution margin, and we have to determine the break-even point. So, finance, the reason why we are studying accounting is because finance is like the lifeblood for any organization, for any business. Can you think of any business which can run without finance of any sorts? Even non-profit organizations need financing, crowdfunding of some kind of contributions, donations to make things happen, right? Because nobody is going to give everything for free. So financial planning is very crucial for any kind of business, because this financial planning is what outlines how they are going to attain their strategic goals through effective fund management so as to optimize the wealth. So with finance being the lifeblood of business operations, a well-crafted financial plan is definitely indispensable. So central to this financial plan is something known as budgets. Budgets serve as the quantitative expressions of future organizational strategies, and they provide benchmarks for internal operations control. Have you heard of the term budgets? Definitely. Does any organization or even the government operate without budgets? We have railway budgets, we have IT budgets, we have infrastructure budgets, all sorts of budgets we have, right? Even the government needs budgets. So you can understand it is very, very, very important, because with budgets we can see how much can be allocated for certain things and whether those allocations were enough to cover the expenses. All those kinds of things we can understand from budgets. So that is why we say that these budgets act as benchmarks. So by adeptly navigating the financial planning, managers can not just increase the company's wealth, but also they can unearth the operational inefficiencies. They can find out the operational inefficiencies. They can cut short on wasteful spending, and also they can rectify any sort of weaknesses in the organizational framework, and all of these is possible through budgets. So a budget is a quantitative plan typically spanning 1 year, detailing the allocation of resources, like maybe it is labor or materials for the business for that particular function. So in business, it forecasts the future costs as well as revenues, and it can be categorized into capital budgets for new projects and operating budgets for short-term operational goals like maybe production or profit targets. Operating budgets are for the ongoing short-term operational goals. So operating budgets can be further divided into departmental budgets or functional budgets, like maybe sales budgets or production budgets or administrative expenses or raw material budgets. So various types of budgets are there. Subdivision is there for operating budgets as well. So these sectional budgets are then integrated into a master budget, which represents the organization's comprehensive plan. Budgetary control is a very crucial process in the organizational management. Why? Because utilizing budgets can be, we can exercise control over our spending utilizing these budgets. It involves creating various budgets and continuously comparing the actual performance with the budgeted targets. And we'll have to adjust the budgets as is needed based on the changing circumstances. So budgets play a significant role in the financial planning by quantitatively expressing future organizational plans and providing guidelines for the internal operations control. So they serve as essential tools for fostering teamwork through participatory budgeting, identifying and rectifying wastages and losses promptly, and evaluating the managerial performance. Control ratios are vital tools in budgetary control systems that aid in the comparison of actual performance against the budgeted targets. So we have 3 key control ratios, including the activity ratio, the capacity ratio, and the efficiency ratio. We need to be aware of these ratios. So the activity ratio assesses the level of activity that can be achieved during a specific period. Okay, that is activity ratio, the level of activity that we can achieve during a specific period. Capacity ratio gauges the utilization of budgeted activity hours, whether So how much is our capacity and how much we need. Like that, if we find out the ratio, that will tell us the utilization of our budgeted activity hours. Meanwhile, efficiency ratio evaluates the overall production's efficiency. So all these ratios are expressed as percentages. So a ratio of 100% or higher is deemed favorable, whereas less than 100% is considered unfavorable, signaling potential areas for improvement. So performance budgeting and zero-based budgeting, these are the two innovative approaches that are transforming the traditional budgeting practices. Questions have come up from this section on performance budgeting and zero-based budgeting in previous term and examination papers. So please do study them carefully. Performance budgeting focuses on expressing a management's plans in the financial terms for specific time periods, enabling performance appraisal and follow-up actions. So here budgets are crafted based on projected organizational performance with the actual performance compared against the budgeted targets. So this facilitates the identification of areas where organizations fall short of expectations, prompting corrective actions. So that is performance budgeting. On the contrary, we have zero-based budgeting. It mandates the justification of every program. Whether it is new or whether it was done last year, doesn't matter. During each budgeting cycle, we have to justify each of these programs again and again. Why we need it this year. We had it last year or maybe we didn't have it last year, doesn't matter. But every budget starts from zero. That is why it is called zero-based budgeting. So every year we have to justify why we need it this year. Why we need to do this activity this year. So this approach currently it is gaining traction in various government departments as well because it enhances the accountability and resource allocation efficiency. This approach ensures that no activity or any kind of expenditure is automatically approved solely based on past practices. Just because we had this expense last year, so we are saying that this will also be there this year without any kind of rational justification for it is not going to work out in zero-based budgeting. So it becomes more efficient because every time you are questioning, do we need it? Do we really need it this year, right? Or do we need it this time? So instead of proponents of activities, proponents of these activities, they have to substantiate their necessity and demonstrate reasonable resource allocation based on projected outcomes. So the zero-based budgeting methodology aids in pinpointing any kind of unnecessary expense and reallocating resources to more impactful areas. So both methodologies, whether it is performance budgeting or zero-based budgeting, both of them, they have the same aim. That is to elevate the effectiveness of the budgetary control systems through transparency, accountability, and strategic resource allocation. But the choice of whether you have to go with performance budgeting or you have to go with zero-based budgeting should be based on your organization's priorities as well as objectives. Why? Because as with anything, each approach, each choice here offers a very distinct advantage that is tailored to the different organizational needs. Performance budgeting, it focuses more on the performance measurement against predetermined outcomes. So this becomes advantages when an organization is seeking to achieve specific targets and assess its performance against such benchmarks. So it facilitates the identification of underperforming areas, prompting for any kind of corrective actions as might be necessary. Whereas in zero-based budgeting, it entails justifying each program comprehensively and reallocating resources to enhance the productivity. So this becomes beneficial when an organization is aiming to identify and eliminate any kind of unnecessary expenses. By scrutinizing every program, it will ensure that resources are only channeled towards the most impactful areas. So I hope you got a basic understanding about the various budgets and the budgetary control systems. So the main objective of any business enterprise, what is it? Make profits, right? Why do we start a business? To make profits. How do we make profits? We can make profits by maximizing our sales and at the same time minimizing our cost, because we cannot increase sales price beyond a certain point, right? Then it will not be affordable to most of the population. And there are chances of rivals coming out with lesser prices. So maximizing profit does not always mean maximizing the price. So the other method of increasing our profit margin is if we can source our materials. The production cost, if we can cut down, that will also mean a larger profit for us without increasing the price. So that is the main objective of any business, especially for-profit businesses. And that is the for-profit businesses are the aim of, or the primary concern when we talk about all these concepts in MBA. We are not talking about the non-profit organizations. Usually we talk about this for-profit business whose aim is to maximize profits. So variance analysis is a tool which is used in the budgetary control. We saw about budgets last, right? So this variance analysis is a tool that is used in this budgetary control in order to compare the actual performance with the budgeted performance and identify variance. So analyzing these variances can help or identify areas where we can improve operations and reduce costs and take any kind of remedial measures so as to improve the performance as well as profitability. The profit statement has to contain notes explaining the causes of variances with greater attention given to adverse variances, those which went beyond our, the costs or the expenses went beyond our plan. If it happened, then definitely we have to write down, we have to give a note explaining why it went out, why it went above it. Right? So variance is the nothing but the difference between the budgeted or the standard level of activity and the actual level of what happened. So in the context of business profitability, it is important to analyze both the cost as well as sales variance. So cost variance is the difference between the standard cost and the actual cost, whereas sales variance is the difference between the budgeted sales and the actual sales. So if the budgeted sales is, or you can say the actual sale is less than the budgeted sale, we have to find out why it was so, and we have to give the note. Similarly, if the actual cost was more than the budgeted cost, also we have to we have to provide the reason of why it went that way. So variance can be favorable or it can be unfavorable depending on whether the actual cost or sale is less or more than the standard or the budgeted cost or sales, right? So cost variance represents the disparities between the standard and the actual cost, and these cost variances can be further categorized into direct material, direct labor, overhead and sales variances. Direct material variance reflects the differences between the standard and the actual cost of materials that are used in production. Further, it is categorized into price and usage variance. And direct labor variances signify differences between the standard labor cost and the actual labor expenses, subdivided into rate and efficiency variances. Overhead variance denotes the gap between the standard and the actual overheads, segmented into fixed overhead cost, fixed overhead expenditure, variable overhead cost and fixed overhead volume variances. Sales variances portray the differences between budgeted and actual sales with subcategories including sales price, sales volume and sales value variances. These variances help businesses analyze their performance and make informed decisions to optimize operations and improve the profitability. Variances have to arise from controllable as well as uncontrollable factors. Controllable factors like changes in production methods or raw material quality are within the management's control, whereas uncontrollable factors like market conditions or economic changes, these are not. So management aims to minimize the impact of these uncontrollable factors and adjusts the budgeted or the standard performance accordingly. Regular variance reports detail budgeted and actual performance, identifying responsible departments or executives for adverse variances. Variance reports provide detailed information on budgeted or standard performance, actual performance, the extent of variances, and the departments or the executives that are responsible for adverse variances. So with this information, management can assign the responsibility for controllable variances and implement measures to prevent any kind of recurrence. On the basis of these reports, the management can fix the responsibilities on the executives for controllable variances and take necessary steps so that such variances do not occur in the future. Controlling variances is crucial for effective management planning and cost reduction. By closely monitoring cost and sales performance, management can identify areas for improvement and take corrective actions to enhance the profitability. So this will involve setting targets, comparing the actual results with predetermined standards, and analyzing the causes of deviations. To control variances effectively, several steps are necessary. First, we have to identify the cost of variance. Once we identify the cause of variance, we can follow it up by taking timely remedial measures to address those causes. Regular submission of detailed variance reports to management will allow for immediate corrective action. Assigning responsibility for controllable variances to different departments will ensure there is accountability and will also encourage proactive measures to prevent any sort of recurrence. However, it is very vital to emphasize the variance analysis alone is not sufficient to minimize the cost. Just because you have a variance analysis in place does not mean you are going to reduce the cost. Effective managerial action that is guided by this variance analysis is what is crucial. We have to act upon these variance analysis. It is one thing to get the variance analysis done, but it is a totally another thing to act upon that analysis. If you just have the paper with you, it is not going to help you, right? You have to act. So managers have to promptly respond to these variances and exercise proper control and closely monitor operations so as to optimize efficiency as well as improve the performance. If you are part of any organization, or if anybody in your family is part of any kind of organization, sometimes you might get a booklet stating what all the things they did, what are the things they did in that particular financial year, what are the what you can say, what were the costs, what are the profits or the revenue streams that they were able to generate, and such things, right? A small book you will get. That book is called the annual report. If you have not already, if you haven't seen one already, just dig up a little bit, do a groundwork. At least it will be there in one of your relatives' house. So in my house especially, the annual reports that I've seen, we used to get one for our parents, especially from our school, because it was a public kind of, it was a community kind of school. And then also from various sabhas and all, which my father is a part of. So we get these small books which have the reports and things like that. So if it would be great if you guys can get one from any place. If it's not coming to your house, then maybe one of your relatives' house. Definitely just dig around, or maybe in some libraries also you might find, or at least search in the Google and try to get your hands on one of any company's annual report. Okay, so why? Because it is a very interesting statement from the managerial perspective, and also because it will help you learn more about this particular unit. Okay, because it is important that we have to understand annual reports. Whether we are planning to invest in any, as a manager, especially as a top level manager, or we might have to decide, or as a business owner, you might have to decide whether or not to invest in certain things, or as a manager, you will have to share or prepare these annual reports, or use these annual reports in order to figure out how best you can manage your organization. So annual reports are very crucial for us managers. So let us see what this annual report is, what are the information that it contains, okay, so that we can read the annual report properly. More than just the words, we can read between the lines and figure out what is said in these annual reports. So annual report, as the name suggests, it is a report that is prepared annually. It contains information about a firm's businesses as well as the financial position and the performance. So the readers of this annual report, they can navigate through this to learn about the qualitative aspects with respect to the firm. So various stakeholders are interested in these annual reports, like investors, analysts, suppliers, customers, even employees. All these people use the annual report to facilitate decision making in areas like investments, credit granting, establishing customer-supplier relationships. So therefore, learning about annual reports is important for anybody who wants to understand a company's financial position and as well as performance, and make informed decisions based on those informations. The content of an annual report is divided into 4 broad categories: non-audited information, financial statements, notes to the accounts, and accounting policies. The non-audited information is further classified into narrative and non-narrative items. Narrative items include the chairman's statement, director's report, operating and financial review, statement of corporate governance, auditor's report, statement of director's responsibilities, sustainability report, management discussion, analysis, and so on. And non-narrative items are the financial highlights of the year, the shareholder information. We'll have financial statements like the balance sheet, profit and loss account, cash flow statements, or even the notes to accounts will be there in the annual report. And the notes to account especially, they provide the additional information about the financial statements. So last time in variance we said that if there is an unfavorable variance, then definitely we need to have a note, right? So those notes, such notes will be there in annual report about the financial statement. Accounting policies will also be there, which will describe the company's accounting principles and methods. So that will give us an idea on how these financial statements were actually made. So annual reports are a very great source of information to learn about the qualitative as well as the quantitative aspects of the company. The management discussion and the analysis section in the annual report provides the management's perspective on the company's overall economy, their outlook on the industry that they operate in for the year that
just past. So the previous year. So what went right and what went wrong, all these things will be there in the annual report. And what they foresee for the year ahead also will be there. So additionally, the financial statements that are included in the annual report, they provide the quantitative information about the company's financial performance, including the revenue, the expense, the profits, and even the cash flows. By analyzing and understanding these financial statements that are provided with this annual report, we can gain insights into the company's financial health as well as the performance. So overall, annual reports, they are very valuable for investors, analysts, suppliers, customers or employees to facilitate decision making in areas such as investments, credit granting and things like that. So how do we analyze the financial position of that firm from the annual report? So we have to focus on the financial statements, which are will be there, the balance sheet, the profit and loss and the cash flow statement. So the balance sheet is, as you know, it provides the snapshot of the assets, the liabilities and the capital at the specific time, indicating the firm's financial health. The profit and loss account reveals the revenue, the expenses and the profits over a period that reflects the operational performance. The cash flow statement tracks the cash inflows and outflows that are vital for assessing the liquidity. Additionally, scrutinize the accounting policies disclosed in the report because they will influence how the reported figures are made. Different policies can lead to varying results. So understanding the chosen policies of that particular firm is very crucial if we have to interpret the financial statements properly. So overall, analyzing and understanding the financial statements of a firm from an annual report requires careful attention to detail and a very good understanding of the accounting principles. The main difference between the annual reports of public versus private companies lie in their preparation in the content and the audit requirements. Private companies adhere to the Companies Act 2013, while public companies have to comply with the SEBI's LODR regulations. Private company reports typically contain mandatory performance information, whereas public company reports often include marketing material for investors. While public company financial statements are audited, private companies may only audit if it is necessary for business purposes. Government company reports governed by the Companies Act of 2013 are presented to the Parliament or the state legislature, offering stakeholders valuable insights for decision making. There is something called as a green annual report. It is a company's financial report that is produced. So the report content is the same. When you say green annual reports, the only thing is that annual report itself is produced using eco-friendly practices in order to conserve energy, trees, water and reduce waste and greenhouse gases. So maybe the ink they use or the paper they use, those things will be much more, what you can say, sustainable, eco-friendly. That is what is green annual reports. Okay. So the primary distinction from a standard annual report and a green annual report is the use of, say, the soy-based inks, which are more environmentally sustainable than the petroleum-based alternatives, because soy inks offer a brighter color and facilitate paper recycling as well. So the report typically includes an eco-audit statement detailing the environmental benefits that were achieved, such as like preserved the number of trees that they were able to preserve, or the gallons of water they were able to reduce, and how much gallons of greenhouse gases they prevented from getting emitted because they created this green annual report. So what happens is that it provides a transparency on the report's ecological impact. So if you see green annual reports, don't think it is something else. Okay, it's just that the paper, the ink and things like that are different. All the other things remain the same. I would say this is just another facade to make us less guilty of the overproduction that we are doing. But anyways, so yeah, that is the green annual reports. So now another very important tool, analytical tool in our arsenal that we have to build out is the ratio analysis. Ratio analysis is a vital tool for assessing the financial statements and establishing a relationship between various items like the balance sheet, the income statement, and the cash flow statement. It aids in evaluating a firm's financial performance from multiple stakeholders' viewpoints, including the shareholders, the investors, the creditors, and others. By examining profitability, liquidity, leverage, coverage, efficiency, and valuation ratios, stakeholders can identify the strengths and weaknesses, guiding them with informed decision making.
Profitability ratios are crucial metrics for evaluating a company's profit generation in relation to or relative to its revenue and investment. So these profitability ratios, they offer insights into different aspects of profitability and investor appeal. Key ratios are in terms of profitability include net profit margin, which shows the percentage of revenue converting into net profit after expenses, return on assets, that is ROA. It measures profit efficiency, that is related to total assets that are employed. Return on capital employed, that is ROCE, is another profitability ratio. It evaluates profitability concerning total capital invested. Then we have return on equity, that is ROE. It assesses the return on shareholders' equity investment. And the price earnings ratio, that is PE ratio. If you guys have seen stock markets or anything like that, then definitely, or you have heard something about it, then you must have heard these people who suggest to buy certain stocks or hold or sell. They all look at these values, and based on that only they suggest you. Not just that, so based on that plus what they know about the particular company or the particular industry that the company is operating in, so based on all these factors only they say you buy this share or you sell this share, or keep it at, give a stop loss at this particular target, like give this particular amount as your stop loss, or you set the target like this. All those values, right, all those analysis that they do it based on these profitability ratios. And in that also this PE ratio, I've heard many people stressing a lot on this PE ratio. So this PE ratio, it compares market price to earnings per share, reflecting investors' expectations and valuation. So from this itself you must have understood, if not that how important understanding the concepts of MMPC 4 is, especially like if you are in if you are coming from a non-commerce background, you do not know accounting, and this is the first time that you are learning accounting. Most of the students I have seen, they get stuck up in how to create balance sheet, how to create profit and loss, how to create the cash flow statement or balance sheet, or how to write a ledger, how to write journal, like that. Those kind of things, the very first block, that problem aspect they get stuck on, saying that this is a problem paper. No, I'm not saying it is not a problem paper, neither am I discouraging you from studying it, but that is not what is the key focus of this particular course. If it was, then we would have seen how to create more and more, right? If you look at the 12th standard or the 11th standard CBSE, you check any NCERT textbook, you just need to check the NCERT textbook, 11th and 12th NCERT textbook on accounting, you will see in how depth they have said. Okay, so if that was so important for us managers, then they would have done a lot more explanation on that, but that is not the case. These preparations of accounting statements, they form a very small percentage. Maybe you will get one question, or maximum you will get only one question or so. That is a pattern so far, and with that one question you can pass, definitely. I'm not saying that you won't pass or anything like that, but see, the bulk of the paper is not in that. The bulk of the paper, and what is more expected out of a manager, is that you be able to understand all the accounting aspects, understand the financial aspects. And furthermore, now you are in the first semester. In the second semester, you will have another paper called MMPC 14, Financial Management, that builds upon all these concepts like ratio analysis, cost, volume, profit graph, all those things. It builds upon it and discusses further topics. Okay. So there also we have certain numericals. I'm not saying numericals are not there or that they are not important, but what I'm saying is, don't lose your focus on the other aspects just because you are focusing on numericals and it is tough for you. Okay, so these things, see, these learning about the ratios, they hold more importance. I have always felt that they hold more importance as not just as managers, but as people who have to manage our own finances. These kind of things, they will help us more than learning how to write a ledger or learning how to prepare a cost volume, like a cost statement or income statement. We can get that done by any audit person, any person who have studied, any accountant you can approach to get that done, any auditor you can approach to get those things done. But where to invest, how to select a company for investment, or how to select any kind of an avenue for investing, or when to decide whether we have to disinvest or stop loss and get out without suffering more losses. That kind of things is taught in the remaining blocks. That you have to concentrate more, I would say, from a practical point of view. Not just in MBA, but outside that also. Like, that is why I stressed on the importance of these ratios even in our daily life, because we all have to manage our finances. We all have to see how we can invest and how we can make our money grow, because other than that there is no way out for us, right? The job market is such, the salary which we are getting is such, so there is no other way. So please focus on all these things. If you are from the commerce background and you know it, I'm not shunning it, but If you are not from the commerce background, if you are finding it difficult to understand how to prepare all those things, please don't waste your time on that. Okay, you have to learn the other things also, and combined the other things are definitely more important than learning to prepare a income statement or any kind of financial statement preparation part. You as manager need to know how to read them and how to take decisions based off them. Okay, so we saw about the profitability ratios. Now let us look at the liquidity ratios. So liquidity ratios are again another vital indicator of a company's ability to meet its short term financial obligations. Why? Because they gauge the liquidity and the capacity of the company to cover immediate liabilities. You have heard the term liquid, right? Solid, liquid, gas, all three states. So what is a liquid? What does it mean if a company is liquid? Liquidity, when it comes to finance, is referring to the ease with which any asset or any kind of security with the company or with a person, how easily can you convert it into ready cash without affecting its market price. Okay, like for example, if you have bought a piece of land for 5 lakh rupees, and you have bought you have bought some shares for 5 lakh rupees, and also you have put an FD in 5 lakh rupees. Of these, maybe the stock or the FD, one of these would be the most liquid, but the property that you have, that will not be very liquid. The reason being, you have to first find a buyer to buy that property, then you have to agree on the price, then you have to make the agreement, then you have to receive the cash. Lot of things are there. But more than that, maybe you can sell the stocks and get the money, or even you can break the FD and get the money. So whichever it is, with the least effect on the market price, that is liquid. So liquidity is that is why we are saying what is liquidity ratios. They gauge this liquidity, the ability of the or the capacity of the organization to cover any kind of immediate liabilities in cash. Why? Because if there is a debt and if the company is not liquid, then it will be very difficult to pay off that debt, right? So when it comes to liquidity ratios, we need to be aware of two key ratios. They are the current ratio, which compares the current assets to the liabilities in order to assess the short-term obligation coverage, and a higher ratio. So the current ratio compares the current assets to the liabilities, and it assesses the short-term obligation coverage. So if this current ratio, if it is higher, then it indicates that your company is better liquid. And the second type of ratio, second type of liquidity ratio is the quick ratio, or it is also known as the acid test ratio. This measures the ability to meet liabilities without inventory sales using only the most liquid asset. That is, without having to sell off any inventory, how you can meet liabilities. That is what is shown in the quick ratio or in this acid test ratio. So higher ratios over here in this quick ratio, they signal stronger liquidity, and lower is the risk of default. So these metrics, these liquidity ratio metrics, aid investors as well as creditors in evaluating the short-term financial health and liquidity risk management. We have one more type of ratio, that is leverage ratio. So far we saw two types of ratios: profitability ratios that gauge the profit efficiency and growth potential. Then we saw the liquidity ratio indicating the short-term financial health and obligation coverage. Now let us look at leverage ratio. So leverage ratios offer insights into a company's capital structure and its capacity to meet financial obligations. There are again three key ratios over here as leverage ratios, which you must know. They are debt equity ratio. This debt equity ratio compares the total debt to the shareholders' equity, and it indicates reliance on debt financing. The debt to capital ratio assesses total debt in relation to the total capital, and it provides a broader view of financing. The interest coverage ratio is the third type of leverage ratio. It gauges the ability to cover any interest expense with EBIT, that is earnings before income tax. This reflects the financial health and debt servicing capacity. These ratios are vital for a stakeholder to evaluate the financial risk, the solvency and debt management, aiding investment and lending decisions. Coverage ratios, they are the fourth type of ratios that we must know. Coverage ratios are crucial for assessing a company's financial health. It measures the ability to meet financial obligations, especially we are talking about interest payments. So again, there are two key ratios here. Time interest earned, TIE, times interest earned ratio, indicating the company's capacity to cover interest expenses with the earnings before income tax, and the
debt service coverage ratio, DSCR, reflecting its ability to meet the debt service obligations. So a higher times interest earned ratio will signal a stronger financial health, whereas a debt service coverage ratio above 1 suggests sufficient cash flow to cover the debt service. These ratios again, they aid the investors, the lenders and the creditors in evaluating the risk and instilling confidence in a company's ability to manage their debt effectively. So these are all the various ratios that any financing firm, any creditor or any investor would look at before deciding to invest. Okay, so efficiency ratios, they are also known as the activity ratios. So they gauge a company's operational effectiveness in leveraging its assets and resources to generate revenue. Key ratios over here include the inventory turnover ratio, which measures inventory management efficiency, the debtor turnover ratio, reflecting receivables collection efficiency, the creditor turnover ratio, indicating payment management effectiveness, and the assets turnover ratio, assessing asset utilization efficiency. So higher ratios again signal better efficiency in their respective areas. These metrics are pivotal for management to optimize operations as well as cash flow. Investors and creditors also rely on efficiency ratios to evaluate a company's operational performance and financial health, making them indispensable for informed decision making. Investment ratios, also known as valuation ratios, are pivotal for evaluating investment attractiveness from the shareholder's perspective. So these metrics offer insights into the market's perception of a company's financial performance and the growth potential. Again, over here the key ratios include earnings per share, that is EPS, indicating profitability per share. We have the price earnings ratio. It reflects the future earning growth expectations. We have the dividend yield ratio, showing the return on investment through dividends. We have the market to book ratio, that is MB ratio. It indicates the growth potential and asset value. So all these ratios, they aid investors in assessing a company's financial performance, the growth prospects and market valuations, enabling informed investment decisions as well as portfolio optimization. So in a nutshell, if I am to talk to you about ratio analysis, what you have to understand about ratio analysis is that ratio analysis and all these various ratios that we have covered in this very short span of time, all of them, they provide valuable insights into the financial performance of our organization, supporting stakeholders in their assessment and decision making. So financial analysis, by now you must be aware, it serves as a very vital tool in understanding a company's performance and prospects, guiding stakeholders in strategic decision making and risk management. So various methodologies and techniques are employed to dissect this financial data, and each of these techniques offer unique insights into the different aspects of a company's fiscal health as well as the fiscal trajectory. So now let us explore some of these key techniques for analyzing the financial performance, their applications, and the inherent conditions that are considerations that are associated with the use. So one of the fundamental approaches to analyzing financial performance is through comparative statement analysis. Comparative statement analysis. So this is a technique which involves the comparison of financial statements for at least 2 years to discern the changes and trends that happen over time. So by examining changes in line items like assets, liabilities, and equity, stakeholders can assess the shifts in financial health, profitability, as well as liquidity. So for instance, say by comparing the balance sheets of a hypothetical company, let's say ABC Limited, for 2 consecutive years, say analysts, if they can compare it, they can calculate the changes in the various financial metrics and express these changes as percentages. So this method of comparative analysis, it helps to identify the trends and patterns, offering valuable insights into the company's financial standing. So that was comparative statement analysis. Now let us look at common size analysis. Again, this is another indispensable technique that can be used to analyze financial statements. And in this approach, it involves expressing each line item as a percentage of a common base. It could be that common base could be total assets or net sales, anything. Okay, so all the line items, each line item is expressed as a percentage of this total asset or net sales. Like for example, the sale of this particular product was 5% of our total earnings or total sales. And let's say for example, Samsung. Okay, so the Z series amounted to 10% of the net sales. The Monster M series amounted to say 20% of the net sales. What else is there?
Yeah, so like that. So that is common size analysis. So by standardizing the financial data, analysts can compare the relative importance of different items within the financial statements and assess their impact on the overall performance. Like for example, in a balance sheet, if you are taking, each item is expressed as a percentage of the total assets, facilitating comparisons across time periods or with their industry peers. So common size analysis, it aids in identifying the trends, patterns and outliers, thereby enabling a deeper understanding of a company's financial health, profitability as well as liquidity. We have another analysis that is called trend analysis. This trend analysis provides a longitudinal view of financial performance by examining data over extended periods, like typically around 5 years. So this technique helps identify changes as well as patterns in financial metrics over time, offering insights into the company's trajectory as well as performance stability. So by analyzing key indicators like sales, profits and balance sheet items, analysts can track evolving trends and assess the company's financial health, profitability as well as liquidity. Trend analysis is particularly useful for identifying long-term patterns and assessing performance relative to the industry peers or benchmarks. Interfirm analysis, also known as cross-sectional analysis, is another type of analysis where the comparison is between a company's financial performance and that of its competitors or even industry average. So the comparison happens between the company's financial performance with the competitor's financial performance or even the industry average performance. By benchmarking the financial performance of our company against the peers, analysts can identify the relative strengths and weaknesses, facilitating strategic decision making and performance improvement initiatives. In addition to analyzing these financial statements, analysts will also be comparing the financial ratios that we saw earlier in terms of, so financial ratios will be compared with similar firms in terms of say sales or size or any other relevant factors. Interfirm analysis is instrumental in identifying the trends, the patterns and outliers, providing valuable insights into a company's competitive positioning as well as financial performance. We have one more type of analysis that we have to learn. It is an important type of analysis. It is called as the DuPont analysis technique. So the DuPont analysis technique offers a comprehensive breakdown of the return on equity. Remember this ratio? We just saw it a few minutes back, right? So DuPont analysis offers a breakdown of this return on equity ratio into its components. What are the components of this return on equity ratio? The profit margin, the asset turnover and the equity multiplier. So this DuPont analysis approach highlights the distinct contributors to performance and efficiency, enabling stakeholders to assess the company's financial health and profitability. By evaluating profitability, asset utilization and leverage, analysts can identify drivers of this return on equity and pinpoint areas for improvement. So the DuPont analysis technique is particularly useful when it comes to identifying the strengths and weaknesses, guiding strategic decision making, as well as assessing overall financial health of our company. So as you must have noticed by now, financial ratios find diverse applications in evaluating a company's financial performance from different stakeholders' perspectives. Shareholders will be assessing the profitability and financial strength, whereas creditors will be evaluating the creditworthiness and the loan viability. Management also relies on these ratios to track overall performance, and analysts they use them for valuation and forecasting through all these different analysis techniques that we saw. So financial ratios are, again, they are also used in credit analysis in forecasting whether the company might go bankrupt, valuing the firms, and despite their utility, financial ratios, they actually require cautious interpretation. And while we are analyzing the financial ratios, we have to consider factors like the industry dynamics, the accounting practices that were used, as well as the economic conditions. So in a nutshell, we can say that analyzing the financial performance entails utilizing various techniques like comparative statement analysis, the common size analysis, the trend analysis and all, to gain insight into a company's fiscal health and inform strategic decision making. But a careful consideration has to be there about the contextual factors, because that is crucial for acute and accurate interpretation. So by now, I hope with at least by saying this much, almost around close to 30 minutes, half an hour we spent just on ratio analysis and all the various analysis statements, right? So whether it is for the examination point of view or for your personal development, I strongly suggest you go through these 2 units and understand them as best as you can. Not just your examination point of view, but I strongly believe that these 2 units, they will provide you, especially the ratio analysis and this even these different various fiscal analysis techniques. They will provide you with crucial financial insights and to understanding how you can manage your own finance and your own investments as well. So it is a humble request, if you don't have time now, then also it is fine. Before you start your next semester, please go through them and understand what is told. It's very, very, very important. So human resource accounting, or HRA, it is a pivotal thing for organizations because it quantifies the value of their workforce in financial terms. As you all know, without human resources, we cannot bring forth, or we cannot put forth exceptional organizations, exceptional businesses. This human resource is one of the unique resources with any organization. So therefore, it becomes important that organizations know the exact value of their workforce in the financial terms. By treating employees as assets rather than costs, the HRA, the human resource accounting, it empowers organizations to take informed decisions on the resource allocation, on human capital investment, as well as performance management. So let us dive into human resource accounting's intricacies and explore the significance, the applications, and the various models and techniques that it employs. At its core, human resource accounting identifies, measures, and communicates the cost and value of human resources within an organization. So this involves quantifying the employees' financial contributions and presenting this data to management for strategic planning. So through this human resource accounting, organizations can gain insights into the workforce impact on the bottom line of the business, aiding decisions on recruitment, training, as well as development. So a key aspect, or the key objective of human resource accounting, becomes in providing actionable information for enhanced decision making. Understanding the human resource initiative, the financial implications of this enables to make informed choices on resource allocation as well as investment. For example, human resource accounting aids in developing cost-effective recruitment strategies or assessing the employees' training programs. HRA serves as a valuable management decision tool, offering avenues for analysis and evaluation. It enables quantifying human resources contribution to the overall performance metrics, aiding workforce planning and resource allocation. Additionally, it also assists in developing the cost matrices for recruitment, optimizing the hiring processes for better outcomes, and also provides insights into specific HR tasks like training and development and prioritizing initiatives for maximum returns. So in the recent years, we have seen a growing HR accountability focus for organizations that are driven by various business landscape developments. Concepts like the triple bottom line emphasize the need for responsible HR practices, considering the environmental, social, as well as economic impacts. And we also have to assess and the access to funds for HR initiatives is again very critical in attracting the right talent, enhancing organizational appeal as well as competitiveness. Compliance with employment laws and regulations become paramount, ensuring legal as well as ethical HR practices. The shift to a knowledge-based economy spotlights human capital management. Therefore, it also necessitates that there is efficient HR practices in place to optimize talent acquisition as well as retention. Additionally, management pressure also demands HR initiatives to demonstrate value creation, driving HR professionals to adopt metrics as well as reporting mechanisms. HRA is closely related to HR management concepts like human capital management, human resource development, as well as planning. These aim to maximize human resource value within organizations. Human capital management focuses on identifying, developing, and retaining talent to achieve organizational goals. Similarly, human resource development enhances employee skills and knowledge, driving organizational success. Human resource planning forecasts future HR needs, aligning HR practices with organizational goals. So techniques like human resource information system and audits manage and evaluate HR practices effectively.
The focus here is the focus on HR accountability intensifies due to certain key developments, like as I said earlier also, the triple bottom line. The triple bottom line broadens business success metrics to include environmental, health as well as social impacts, necessitating HR practice accountability within a sustainable context. Access to funds also, we said earlier. Availability of funds enables HR initiatives, therefore enhancing the organizational appeal through the employee development, wellness and diversity programs. Everybody would want to work with an organization that prioritizes employee well-being, that prioritizes employee learning, correct? The same thing. So compliance, this is another important factor. Adherence to employment laws and regulations ensures that there is legal and ethical HR practices and maintaining organizational trust as well as credibility. Human capital management focus shifts to high-tech industries. So they spotlight human capital management, and this drives HR practice accountability for talent acquisition, development as well as retention. Accountability demand from management. So resource competition is what drives management to demand evidence of HR initiative effectiveness. And this is what pushes for a quantified impact on the organization's performance. So the human resource accounting models, they help measure the human resource value. And how they do that is there are various methods. So first method we have to know about is the original cost model. Here it calculates the historical human resource acquisition and development cost, but this method, it overlooks the value changes that happen over time. Then there is a replacement cost model. This estimates replacing the cost that is involved in replacing existing employees. Again, this method also, it checks how costly it is to replace an existing employee, but again it disregards the value changes that would have happened over time. The other method is, or the other model of HR human resource accounting is opportunity cost model. So in this model we assess the opportunity cost of resource allocation. But again, so I hope you know by now what the opportunity cost is. So the opportunity cost is the cost that you incur because you chose one option over the other. So because there will be multiple options to choose from. So for example, one person, so when it comes to the human resource context, so one person might have multiple skills, and there might be multiple projects which would need one of the skills of this person. So when you choose to allocate this person A into project A without allocating him into project B, which also needs the similar skills, you will be having a cost. Okay, so that cost is the opportunity cost that is associated with the resource allocation. Again, this is a very challenging thing to calculate. Then we have the present value model, which determines the present value of future earnings, requiring extensive data and calculations for accuracy. So each model of human resource accounting, it has its own advantages as well as limitations, catering to organizations' needs, resource allocations, organizations' needs, the resources, the strategic objectives, and all those things. So overall, HRA enables effective human capital value measurement and management, enhancing decision making and organizational performance. So this is the last unit in MMPC 4. I thought of having it as a very rapid roundup, but because of the vastness and the character of this particular course, accounting, and because it is a new thing for many people, I had to explain. So it did drag a little bit. Thank you so much for your patience if you have made it so far. So anyways, so I will wind it up as quickly as possible. This is the very last unit here. So fraud. It all leads it, forensic accounting. So why do we need forensic accounting? Because there is a crime. What is the crime? When it comes to finance, what is the crime? Fraud, financial fraud. We are all very much aware of the various types of financial frauds that are happening these days, right? So what is fraud? Let us try to understand forensic accounting by understanding what exactly fraud is and how fraud happens and things like that. Okay, so what is fraud? Fraud is a deliberate attempt, a deliberate as well as a deceitful act that is perpetuated or perpetrated by individuals or groups that are associated with the business, and it poses a very significant threat to the financial integrity as well as reputation of organizations. Fraud could encompass a wide range of deceptive practices, including but not limited to cash misappropriation, fraudulent financial reporting, and revenue manipulation. So perpetrators of this fraud may include employees of the organization, then management of the organization, the vendors, the customers, or any other party who might have an interest in the business. So the primary objective of this fraud is that is to unlawfully obtain money.
It could be money, it could be services, or any kind of assets. But the key point here is unlawfully obtain them. Okay. So ultimately, this results in the financial loss and damage to the organization's stakeholders. So, in order to comprehend the intricacies of fraud that could happen, it is very essential to explore the underlying dynamics that drive individuals, whether it is your employees or the management or anybody. What drives them to engage in such fraud, in such deceptive behavior? So, how we can do that is by this concept called as the fraud triangle. So, the fraud triangle is a foundational concept in our forensic accounting. It provides valuable insights into the psychological as well as the situational factors that could contribute to fraudulent activities. This fraud triangle actually identifies three key elements, and that is why it is called a triangle. It has 3 points, right? So, three key elements. What are they? Incentive and pressure, opportunity and rationalization, and attitude. So, incentive and pressure is 1 point, opportunity and rationalization is another point, attitude is the third point. So, incentive and pressure, they arise from internal or even external forces which could compel individuals to commit fraud. And these pressures could include financial targets, job security concerns, or personal financial difficulties, right? So, maybe your manager is pressurizing you to meet the target, otherwise it could end up in you losing your job. Definitely, you have enough motive to commit fraud, right? So that is what incentive and pressure is. When individuals face unrealistic expectations or they perceive significant rewards are tied to meeting certain targets, the temptation to resort to fraudulent behavior will intensify. So opportunity refers to conditions within the organizations which enable the fraud to occur. It could be weak internal controls or inadequate supervision or the absence of any kind of segregation of duties. So all these things could create an environment that is conducive to fraudulent activities. And when individuals perceive that there is a lack of oversight or there is a lack of accountability, then definitely they will be more likely to exploit those vulnerabilities and engage in fraudulent behavior. Rationalization and attitude. This involves the mental processes and that perpetrators use to justify the fraudulent actions. Okay, that is, see, I did this fraud because so and so and so. You rationalize, right? That is called rationalization and attitude. So they may convince themselves that their behavior is justified due to perceived grievances, such as maybe it is, I did this because my manager was micromanaging me, I did this because my manager did not approve my leave, right? Some kind of, or I was not promoted but the person who performed weaker than me got promoted, something like that. So the behavior, the employees or whoever is performing the fraud, they might have perceived grievances like unfair treatment or insufficient compensation, so they commit fraud. So rationalization also involves minimizing the perceived harm caused by fraud and shifting the blame onto others or external factors. So the fraud triangle, what are the three things? Incentive, opportunity, rationalization. So rationalization, so additionally, individuals may adopt an attitude of entitlement, believing that they are entitled to the resources that they fraudulently obtain. So forensic auditors, they play a critical role in uncovering as well as combating such frauds that might happen within organizations. Drawing upon their expertise in accounting, in auditing as well as investigation, forensic auditors employ a range of techniques to identify fraudulent activities as well as gather evidence for legal proceedings. These techniques may include data analysis, financial statement analysis, interviews with relevant parties, as well as digital forensic analysis. Fraudulent financial reporting schemes encompass a variety of deceptive practices that are aimed at misrepresenting the financial position as well as performance of an organization. Revenue recognition fraud involves prematurely recognizing revenue before the services are rendered or even the goods are delivered. These perpetrators may engage in practices such as channel stuffing, consignment sales, or even fictitious transactions to inflate reported revenues artificially. Expense reimbursement fraud entails falsifying the expenses to unlawfully obtain reimbursement from the organization. So this may involve submitting false expense reports or altering receipts or claiming expenses for personal purchases. Workers' compensation fraud involves fabricating or exaggerating injuries to fraudulently obtain insurance claims or compensations from the employers. So to effectively detect and prevent fraud, organizations have to employ a combination of preventive measures, detection techniques, as well as corrective actions. Preventive measures may include implementing robust internal controls, conducting regular audits, as well as fostering a culture of ethics as well as integrity. Detection techniques involve monitoring financial transactions, analyzing data for anomalies, and conducting forensic audits to uncover such fraudulent activities. Corrective actions may include disciplinary measures against these fraudsters, these perpetrators, implementing stronger internal controls as well as implementing remedial measures to mitigate the impact of fraud. So, in conclusion, fraud represents a significant challenge for organizations across industries and requires proactive measures and vigilant oversight to mitigate the risks and protect against any kind of financial loss. By understanding the underlying dynamics of fraud and leveraging forensic accounting expertise and implementing comprehensive fraud detection as well as prevention strategies, organizations can safeguard their financial integrity as well as uphold the trust and the confidence that they have among the stakeholders. So with that, we have covered all the major aspects of accounting for managers as was stipulated in MMPC 4 of IGNOU MBA as per the new syllabus. I know this was a very long session. Even the rapid roundup session was this long. So anyways, but no matter what your specialization is, I just want to stress this. I can't stress this enough. Make sure that you study this subject very, very, very well. Because you have, as I said earlier also, you have another course that is called Financial Management, MMPC 14 in the second semester. That is also a common subject. No matter what your specialization is, you have to study that. So that MMPC 14 is actually an extension of this particular MMPC 4 course. And if your specialization is finance or banking and finance, then definitely you know the importance anyway. I don't have to tell you again. So if you have come to the end of the session, then let me ask you, did you find this session useful? Anyways, you staying till here itself is a big reward for me. Thank you so much for tuning into Anu's Classroom. And I definitely hope that you have subscribed to the channel because you have a long 2 years ahead, right? We have only finished one semester. We have 3 more semesters to go. There are a lot of details available in Anu's Classroom, which are also in plans also for the coming semesters. So I hope you have subscribed to the channel and you have enabled the notifications so that you will all get those updates. You will not miss them. Okay, so anyways, all the very best for your examinations. Let us catch up in the next session. Thank you so much. Bye-bye.